Well, joining us now is Verdence Capital Advisors Chief Investment Officer, Megan Horneman. Megan, you were listening to Loretta Mester there speaking to Brian Chung. We've got another CPI print coming out tomorrow, that one very closely watched. It certainly feels like the Fed is chasing inflation right now. How are you looking at the big picture?
So I think what you're seeing in the markets right now is it's just a complete reset and a repricing of not only interest rate, but inflation expectations. So that's why you're seeing a lot of the volatility right now. As you mentioned, the inflation print tomorrow is important because people are looking for some peaking in that year-over-year growth rate over the next couple months. Right now, I think we're in for a bit of a dicey inflation picture through at least the rest of this year, but we are starting to see some inflation indicators peak or come down just a little bit, whether you're looking at freight costs or whether you're looking at inflation expectations in the market where break-even rates have fallen more than 70 basis points in the intermediate term. And then you're also seeing in the NFIB surveys, the small businesses, you're starting to see some peaking in their expectations for raising prices over the near term.
What does that mean from a market's perspective? I mean, this expectation of an accelerated rate hike as well as inflation ticking higher has certainly led to a lot of choppiness. That's probably an understatement that we've seen over the last few days. If you're saying that you're starting to see potentially the peak, what does that mean in terms of what we're likely to see on Wall Street?
Well, the peak is definitely some positive news, but keep in mind that we're still looking at inflation levels much higher than we're accustomed to. So some of these very expensive, high price to earnings multiple sectors and stocks, these areas of the market still, I think, have some room to correct because we are no longer dealing with that easy money policy that we've seen over the past decade. We're looking at higher interest rates, a reduction of the balance sheet. So this is right now what we're seeing is this price to earnings multiple, I think, discovery on some of these more expensive stocks.
It's certainly been especially ugly in the tech sector. Tech giants lost more than $1 trillion in value in the last 3 trading days. How are you positioned in that space right now?
So we've been, your traditional technology, those, those bigger names, your Apples, your Microsofts, these names have been expensive for quite some time. So we're not necessarily overweight in any of those sectors. We have not been in some time. We have been selectively adding to your traditional growth, but we're not necessarily looking at some of those really expensive technology companies. Instead, you want to look at, if you are going into the technology space, look at some of those technology companies that are selling, more business to business. So they're selling software, they're selling semiconductors. This part of the market has been hit as well in sympathy, but yet I think going forward, instead of those consumer type of technology names, that those areas of the market can benefit.
Even among those names, let's say you look at something like a Microsoft, obviously they're in the enterprise side, they've got the services, they've got cloud, which continues to grow. I mean, is it at the end of the day for investors, is it about looking at companies that are in fact already profitable, or can you still buy into growth?
I think not even just from the stock specific name in technology, but across the market, you have to look at what's priced in that peak pessimism. So has it, remember that markets will always overswing from to the upside and to the downside. Has it priced in that pessimism? I think technology as a whole, even some of those names that have fallen the most, still does have some room to correct itself. However, if you do look at some of the other areas of the market, whether it's small or mid-cap stocks, this part of the market has really priced in, I think, what is expected from an economic slowdown, from higher interest rates, and even an elevated inflation environment. So those are the areas of the market that we think have really priced in that peak pessimism.
Really quickly, Megan, how much do you set aside for cash? There's a lot of people who are looking at their portfolio, the losses over the last few days, saying, is it time to just sort of get out, even with the losses? How are you advising clients?
We're not getting out at this point by any means. We came into this year with holding on to some dry powder in a lot of our accounts. We wouldn't recommend selling into this volatility. Instead, we've been actually looking at opportunities to put some cash to work. As I mentioned, the areas of the market that have priced in that peak pessimism. So we've been looking at small and mid-cap area of the market. The international side of the market, again, is really pricing in a lot of the downside, we think, from an economic standpoint, especially especially in Europe. Those are areas of the market that we would take some money and add money to. We wouldn't sell into this volatility, no.
Megan, some good insight there. Appreciate your time today. Megan Horneman, Verdence Capital Advisors Chief Investment Officer.